Internal Revenue Service IRS tax news. Reviewing eligibility for credits and deductions is an important part of year-round tax planning. COVID tax tip 2021-90, June 23rd, 2021. Tax credits and deductions can mean more money in a taxpayer's pocket. Most people only think about this when they file their tax return, but early planning can help make filing their 2021 tax return easier. So, for example, for the year 2021, we don't actually file the tax return until sometime in 2022, generally by April 15th of 2022. And we need to gather all the tax information in order to do so. However, when you're thinking about tax planning, that generally needs to be done in the year that is going by, in the year, in this case, of course, of 2021. That in part is because obviously the activity that's taking place that you're trying to sum up when you actually do the tax return in the following year is taking place at this point in time. And also, you're on usually kind of a cash basis system. Most of the tax code for individual taxes ties into a cash basis system, meaning the cash flow kind of has to happen during the year then in order for you to have a deduction. There's exceptions to the rule, like that's why you always have the IRA deduction or something like that at the end, where you get basically an extended amount of time past the year of 2021 or the tax year possibly to take action that will impact still the current 2021 tax year. But for the most part, the activity that's going to have an impact on your taxes needs to be done in the year that you're doing it, which would be 2021 in this case, not afterwards when you're doing basically the tax planning. Now, note if you have a more basic tax return, then usually it's fairly straightforward. There's not a whole lot you can do if you're just getting a W-2 type of income. And basically, the income is what it is. You might not have a whole lot of tax planning other than to basically figure out your withholdings and get that correct. But usually as the income goes up, tax returns get more complicated because other things will take into effect. You'll usually have different kind of cash flows that will take into place. And also if you get into itemized deductions, which often happens as income goes up, especially as the home is purchased, because then you got the mortgage interest and the property taxes that might push people over to itemizing. And once you're itemizing, then you got to basically count all those itemized deductions. And that's something that you got to do more tax planning throughout the year. So tax planning becomes more important. But even on the low end side of things now, where people's AGI is lower, it's becoming a lot more complicated than it was before because you got these refundable tax credits. So even on that side, you would think tax planning is becoming more important because you might have child tax credits that you're planning for just for your budgeting purposes to see how that's going to work out. The earned income tax credit to see how that, is going to fit into the budget. And then if you have child expenses and whatnot for child care and this kind of stuff, that could be planning type of stuff where you could have, expenses you'd need to track with relation to the reporting of those kind of credits, education credits. You could have a similar type of situation. So those type of things, you want to basically look at the prior year tax return, think about, what's the best things you can do to maximize your tax this year, and then make sure that you are doing them and tracking that information throughout the year. Most of the stuff that you actually report at the end of the year that is easy is given to you by a third party, like a W-2 or a 1099 and whatnot. But some of these expenses or some of the expenses that are related to the calculation of the credits may not be given to you directly. And the other area where people have a lot of problems, of course, is with the Schedule C type of business. And a lot of people are picking up more gig work and stuff like that. So that's another area where you definitely want to be tracking your expenses as you go. If you do not, the IRS may charge you based on just your gross income because they got the 1099s maybe. And that's a problem. That could cause a much greater tax burden than you should have. So in any case, taxpayers should be prepared to claim tax credits and deductions. Here are a few facts about credits and deductions that can help taxpayers with their year-round tax planning. We got the taxable income is what's left over after someone subtracts any eligible deductions from their adjusted gross income. So there's a link to the deductions here. And so that means that we're talking about an income tax here. That means the government taxes us when we make money, when we have income. They generally don't tax us, or the general idea would be that they shouldn't be taxing us on the gross income, the top line income. They should be taxing us on the net income. Because if you thought of it, for example, a business that you had a business, and one business, for example, possibly they have a lot of revenue, but they have to purchase something very expensive. If they buy something and then sell it, but it's a very expensive thing like a boat or something like that, then their gross income is going to be quite high, but they got this huge expense, which is the purchase of the boat. So their margin is what you should be taxed on. That difference is kind of a deduction for the business expenses there. The same idea happens with the individual taxes in general. The deductions that are there that are helping you to generate income are usually the ones that are kind of the more clear-cut types of deductions, but then they added all these other deductions, of course, for all these other kind of random reasons and whatnot. But the bottom line is the after you have the deductions, that's what your taxable income is. Whether those deductions are business deductions or deductions related to income or not, or just deductions that the IRS decided we're just going to allow this deduction because for some reason, whatever they were thinking at the time. But the taxable income then is what you're going to actually calculate the tax on, which is then calculated using a quite complex progressive tax system, which you almost need software to kind of figure out. It's not a flat tax, progressive tax system. And then you got the credits at the bottom that are kind of act more like actual payments rather than a deduction. They're bigger. A dollar of credit, in other words, is worth more than a dollar of a deduction. Okay, so this includes the standard deduction. So the standard deduction is the big deduction that kind of everybody gets. It's an attempt to simplify the code. Instead of having a bunch of deductions that you have to gather together, you just get this flat deduction that hopefully is standardized so that it kind of covers everybody there. So they tried to make it more so more people were taking the standard deduction as opposed to the itemized deductions a few years ago. They might roll that back next year because, they're rolling everything, so it could change. But as of now, a lot more people are taking that standard deduction. So in fact, most individual taxpayers take the standard deduction. On the other hand, some taxpayers may choose to itemize their deductions because it would lower their taxable income. So if your itemized deductions, in other words, were greater than the standard deductions, and that includes things like the mortgage interest, the charitable deductions and whatnot, all those kind of things that we often think about when we think of deductions, you have to have a greater amount of those things than the standard deduction generally for them to be beneficial. And again, one way to simplify the code and not make it, so that people that, a lot of things that itemized deductions kick people over is the home, or if you own two homes that happen to be worth over millions of dollars, right? And you're paying property tax that you get to itemize deduction, and the state taxes that you're itemizing. Usually it's the higher income people that kind of are getting an advantage from the itemized deductions typically and generally. But in any case, as a general rule, if a taxpayer's itemized deductions are larger than the standard deduction, they should itemize. Also, in some cases, taxpayers may even be required to itemize. Taxpayers can use the interactive tax assistance to see what expenses they may be able to itemize. Taxpayers can subtract tax credits from the total amount of tax they owe. So then we have the credit side of things. So if you're on the higher income side of things, itemized deductions is going to become quite important. Then you got to track a whole another set of stuff to make sure that you're maximizing the itemized deductions. If you're below the threshold to itemize, then you don't have to worry about the itemized deductions generally because you don't have enough to go over the standard deduction. But you might be in a situation where credits become a much more important factor. If you're on the high end side of things, a lot of times the credits will phase out because there's usually a phase out for the credits. So you might be over the phase out, credits become less relevant, itemized deductions become more relevant. If you're on the low income side of things, oftentimes, especially these refundable credits, become much more important and the itemized deductions are not as important. These refundable credits used to be fairly basic and straightforward because they weren't refundable. Like a lot of times a credit wasn't generally thought to be refundable because that's more like a benefit program. Now they're refundable, so these get quite complicated too. And these aren't deductions. These are on like the bottom half of the tax return or the second page of the 1040, and they act kind of like payments. And so they can be huge things to calculate as well, and things that you have to do more and more planning for to kind of make sure that you're maximizing your credits now. So to claim a credit, taxpayers should keep records that show their eligibility for it. So note, again, a lot of credits, if it's just a child tax credit, then your eligibility is pretty straightforward. I got a child. It's right on the first page of the 1040. The child's under 17 or whatever the age limit is. So yeah, I'm qualified for that credit. Pretty straightforward. But if you're writing off a credit that's like for the child care expenses or something like that, then, or any kind of expenses that you had up, like an education credit or something like that, and you're trying to add up expenses and whatnot that you may or may not have documentation for, you want to make sure that you track those things so that you have supporting documentation for the credit, because the IRS may not have that information if it's not given on a 1099 or something like that. And if they question you on it 3 years later, you want to be able to pull out the tax return and point to the documentation and say, yeah, here's why I reported what I reported and whatnot. So the American Rescue Plan made changes to several valuable tax credits, including the child and dependent tax credit, the childless earned income tax credit, and the child tax credit. So these are big credits, especially for low to moderate income families. So, and you want to make sure that, again, you understand the rules with relation to these credits, and if you're reporting the credits, that you have the documentation to support them. Some of them more straightforward than others to make sure that you have that documentation. So it's important for taxpayers to understand how these changes may affect the 2021 tax return. Properly claiming tax credits can reduce taxes owed and boost refunds. Taxpayers can check now to see if they qualify to claim it next year on their tax return. Some tax credits, like the EITC, the Earned Income Tax Credit, are even refundable, which means a taxpayer can get money refunded to them even if they don't owe any taxes. So that means this refundable portion means that, of course, again, your tax liability is below zero, then you can actually get more money back. And unfortunately, on the low income side of tax planning, there's some kind of negative results on this. Obviously, on the upper income side of tax planning, then what happens, taxes distort things. So if your income gets to a certain threshold, and you could end up in a situation because of a progressive tax system that if your tax goes up, then you may not qualify for as many of the deductions and the credits and whatnot, and you may be at a higher tax bracket. So the taxes actually disincentivize to some degree increasing income past a certain degree, because the IRS will just take more of it. And obviously, if the IRS took 100% of your income, then what's the point of working at that point, right? So once the tax gets up above a certain threshold in terms of the amount that the IRS takes, then it kind of disincentivizes work. On the low income side of thing, so you have tax planning that could take into consideration that kind of disincentive. On the low income side of things, you have a similar kind of negative impact with taxes. I would think of it sometimes positive, but that would be that oftentimes these, like the earned income tax credit and the child tax credit, these things max out when your income goes above a certain threshold. So to maximize those credits, you're actually incentivized to keep your income below a certain threshold to maximize the credits, or they could go down. Something like the earned income tax credit actually goes up as your income goes up, and then it caps off at some point, and then it goes back down, which is kind of good because it allows people it incentivizes people to generate more income, which is what we would probably want to do, not be, not have most of their income from the government or whatnot. But then it goes back down, and the child tax credit has those caps as well. So it actually, if you do your tax planning, it could incentivize people to do tax planning in such a way that they would be trying to maximize the refundable credits, like the earned income tax credit, which means they might end up, being better off if they cap their income at some level to maximize those credits. But in any case, they're interesting, kind of complicated credits to try to see how they all work together and how the refundable portion kind of works out. So in any case, there's more information that can be found at the links below, including the Advanced Child Tax Credit in 2021. There's a link to that. There'll be a link to this in the description.